If you guys haven't talked to Barnett Capital, make sure to reach out to them in the back. And without further ado, if you guys could put your hands together for Mr. Vince.
Thank you guys. So,
Yeah, not high enough.
so I'm not going to give you the marketing pitch tonight. I just wanted to. You guys can go back to the booth back there, and I'll give you that later. I wanted to give a mini little presentation on private money, hard money, because it's been a while since we've had it presented here. So I'll start. I got about 10 minutes, so I'll start high and dive into some points that you guys should focus on when considering, your finances. So first of all, what is private money, hard money? It's really short-term money that you get to get a transaction done. It's typically never from a bank. There's some banks who get closer to it, but they're never quite as quick. Hard money tends to be more expensive, it tends to be quicker, and it tends to be less document intensive than what you'll get from more traditional lenders. When looking at the money that a lender presents to you, some of the things you really want to focus on are really the math. So there's a lot of kind of cloak and dagger with how this stuff is presented to you. You'll hear somebody saying, "Hey, I can give you 12% money," and you're like, "Oh, great, 12% money. That sounds reasonable compared to this guy down the street doing 15." But you really need to dig into it. You need to open up your Excel spreadsheet and kind of see how it plays out. A lot of times they're going to hit you up for points. Almost all hard money lenders are charging you points. The points are basically a percentage of the loan that you pay up front. So if it's 3 points and your loan is 100 grand, $3,000 up front. Maybe there's points at 6 months. Maybe there's more points at 9. Maybe there's points on the outside when you're closing the loan. These add up. And the number everybody kind of zeroes in on is the interest rate, when points are another big thing that you kind of got to really work on there. If you look at, if say you have a year term, you have somebody at 15% and another person at 12, and they say, "Hey, I'm 12 and 3. Well, if you're paying 3%, and then you're paying 12% for the rest of the year, your annualized number is 15. So that guy at 15 is basically equivalent to the guy who's advertising you 12, but he thinks he's going to get you because you're not going to dig into the numbers. Another important thing to consider is going to be kind of all the little fees that get tacked on. A lot of lenders will do things like charge processing fees. Oh, $1,000 per loan you submit because we got to pay our guys and feed our children and all that. That money's just going into their pocket. It's built onto the interest rate. There's nothing special about it. What you'll find common in fees in all of the guys you're talking about is generally a couple pass-through things that will always come to you that I've very rarely seen lenders not charge us. One will be an appraisal fee. And I think the message is always, you guys probably should be getting an appraisal. Not necessarily because you can't comp it out yourselves. If you have MLS access and you have access to the data, there's no reason why you can't go in there and be just as good as the appraiser. The reason is, at the end of the day, some buyer is going to come along and they're going to get an appraiser, and you want to know what appraisers are going to look at it like. So we, just as a matter of practice, think it's a good idea. We require it for our loans, and almost everybody does, and that's typically a pass-through fee that will end up in your pocket. The other one is if you're funding construction, there'll be inspection fees for that. Almost all lenders use a third party, typically $100, $125 per inspection, and that's just what the inspector charges the lender. The lender will pass that on to you. Most lenders will have a program where they can finance construction. So you'll be able to get your work done and get that work financed. And it'll help you get those deals done. And that brings me to kind of the big point of, a lot of people are kind of reluctant to use these kinds of lenders, saying, "Hey, these guys are going to charge this much. They're going to take so much of my deal. Why would it make sense to use these guys?" And my answer is always, are you getting the deal done without them? If you are, then great. Go get the deal done without them. Are you getting 2 deals done without them? Well, eventually I'm going to hit a number when I count up like that where the answer is no. And the next question will be, would you like to be getting that many deals done? A lender of that nature is going to allow you to do more deals. You might have enough to do 1 deal at a time. You take that same amount of cash you'd apply to that deal, you bring it to a private money lender, that money lender is going to say, "Hey, with that much money, I can probably fund 3 of your deals at a time." So now instead of making 20 grand on 1 deal, you might be making 15 grand on 3 deals, and do the math and you'll see where it falls. So that's my super quick explanation of it. I'll just open up for a few questions if anybody has any before we run along to the next segment of the program.
And then real quick, Vince, just so people, when you're borrowing money on construction funds, are you paying 100% of that interest even on unborrowed funds for construction?
So that's a real good point, actually. Depends on the lender. We never do. We fund money that's actually out the door. A lot of lenders will charge you on that full amount, and it kind of comes down to where's their money coming from. A lot of lenders will raise $1 million to lend $1 million. They'll raise $5 million to lend $5 million. If a chunk of that, like let's say you have a $500,000 deal, if they've only got $5 million, that's 10% of their funds. They can't be allocating those funds to you and not earning off of them. Lenders with more financial backing can be more flexible. They'll charge you only on money out the door, and that's where we stand. We have very strong financial backing, so we don't need to charge you money on money that we haven't funded to you. So that's another very important thing. When you're putting those numbers in that spreadsheet, consider whether you're paying on the full amount funded or not. If you're not, you're going to be doing significantly better.
Yeah, I've looked at other hard money lenders and they've looked better on paper, but when you take that into consideration, you're getting charged much, much more. For example, if you've got a $150,000 rehab and they're charging you interest on $150,000 from day one, that really adds up quickly. So just something to keep in mind when you're looking at working with a hard money lender.
Yeah, we generally don't, we never do that. And our typical annualized rate, if you do no points, is going to be 16.99. And we've had borrowers do the math and say, okay, well, compared to my other lenders who are charging me the full amount, your 16.99 actually ends up equaling something more like 12 on an annualized basis because you're not charging me on the full amount, whereas they would be. So it's another very important thing to consider in your calculations. Anything else before I turn it off?
Asset-based or?
We're always asset-based, and I think most private money lenders will be. There are some out there who have bank money behind them, and when they have bank money behind them, they're typically going to ask you for a credit score and have certain requirements. Many of the private money lenders who have their own money will not do that because they're not relying on a bank ultimately funding the deals in the background.
When you recap a deal, what is the percentage that you give towards the purchase of the property as well as the rehabbing cost?
Sure, so that varies from lender to lender. Just to give you what we do, we fund 85% of total costs.
85.
Yeah, so if you have 100 purchase, 100 rehab, 200 total costs, at closing you'd bring 30,000, which is 15% of the total cost. We'd bring the remaining 70
Closing.
at closing, yeah. And then we'd fund 100% of the construction. And that's how we do it. Others will do 15 of each, so you do the first 15 on each. So it's mixed up in a variety of ways.
Okay. What's your ratio for rehab budget, the construction part to the purchase?
We don't have any ratio.
So you can exceed the purchase price with your rehab budget?
Absolutely, we do new construction. So I mean, we can fund any sort of ratio that you come up with. The deal just has to make sense. From our point of view, if it's a good deal and it papers out, we don't care that you're buying the lot for 20 grand and then putting 400 into it. That's great. You got a deal. We're not gonna fault you for that.
You're saying a good deal. What is a good deal for you?
Basically, when we look at a deal, we want to make sure that the borrower is going to make money off of it.
Sure.
If the borrower is going to make money, we're always going to be comfortable with it. And we're going to rely on comps, and I think most lenders will. So we don't know in a neighborhood like there's a new Whole Foods there, so prices are going to go up 20% over the next 2 years. Maybe that's true, and maybe you know that very well, but there's no way we can confirm that from any data. So we need to rely on the data. When we do that, we look to make sure that based on the existing data, that when you get through this deal, you're going to make money off of it. So we need to make sure that a borrower will make money. If the borrower's making money, we're going to approve pretty much every deal. Now, if it's coming closer where the borrower is coming closer to sort of like a scratch, but they're saying, hey, because of this Whole Foods here, this is going to make money. I know you can't see it in the comps, but it's going to make money. In one of those cases, we can do a couple of things. One is, we're going to go into it with them kind of eyes wide open, like, look, here are the comps. We don't want you to make a mistake here. This is what we're seeing in the comps. You may scratch if you do it this way. But at the same time, we get what you're saying, and we'll let you do it, but we need to reduce our advance rate a little bit. So maybe we're not going to do 85 LTC, we're going to do 80 LTC to give us a little more protection that would have been the profit that they would have gotten otherwise.
What is your turnaround time if I present a deal to you today? When you're going to give me an answer if you're going to finance it?
So our typical turnaround time is a week or two, and I think that's probably not super uncommon among hard money lenders.
I don't think that's what he said. He says getting an answer.
getting an answer if you're gonna.
Yeah, so from your application to closing on a property, a week or two.
No, that's not what
how
I'm
is it
saying.
closing?
Approval of.
Approval on the deal. Let's say I present.
Oh, that takes, basically the main thing we need to do is we get an appraisal. That's the biggest slowing factor. If you tell us, hey, I need this by tomorrow, we'll get on the phone with our appraisals, and they might say, hey, I'll charge double to do it tomorrow. But we can move that quickly. So from you submitting a deal to us saying, yes, we can close on this a couple days, 2-3 days. More typically, it's probably like 5 days, but if you tell us we need to rush, we'll figure out how to rush it. Cool, so I think I'll
Anyone
turn.
else have questions? So what kind of docs do you actually require?
So we go from a low dock to sort of a medium dock range. On the low dock range, we basically need to see liquidity, and we'll do a credit background and identity check. That's kind of the minimum. From there, you can add in income, you can add in assets, you can add in kind of illiquid assets, like if you have retirement funds or other things that we
How
can't.
is that an asset-based deal?
Well, we're coming up with a line of credit for you. And your line of credit is going to be determined by how much you can support financially.
Okay.
And then under that line of credit, we approve each asset, right? So you might have $1 million line of credit,
Okay.
we approve each property under the line. Make sense?
Makes sense.
And when you actually make a loan, what kind of docs do you put together?
Standard stuff, mortgage, we have a business loan agreement, we'll have a note. You know, nothing out of the ordinary there. And I think actually pretty much all of these lenders in this field will do exactly that sort of package. Cool, well, if everyone's done, I'll turn it back to Josh.